Hey guys, Jay here. This is smarthelping.com. I got a new financial model tool here for, well, we're pretty accounting heavy on this one. It's for selling things on account, revenue on account. It's also for inventory logic and also if you have expenses on account. Now I had to, originally I just had these first two, but I had to add inventory as a separate item because it involves a little bit more than just prepaid expenses. So we've added all those three. We've done a monthly financial statement, income statement, balance sheet, cash flow statement for up to 120 months or 10 years, monthly view and annual view, and all this automatically will update as you start plugging numbers into here. It's just a simple monthly log 1 through 120 months. You can enter sales, costs, inventory orders, and then I'll show you how this thing um, does all the correct flow of logic through the financial statements. One thing I really focused on with this model is it's all on one tab. So if you want to port this into your own financial model and then plug your data into here and get these outputs and then reference these into your financial statements, you can do that. Everything balances is all built to perfectly, assets equal liabilities plus owner's equity. You'll get a good cash flow. We've got some visuals down here as well. It took me quite a long time to build this out, and the accounting knowledge required is pretty heavy on this to do it right. I'll show you how each section works, and then we'll show you how um, they can also work together. So, and remember, you can also duplicate this if you have other sales with different terms and patterns for when you collect cash from customers or when you pay. You can always just right-click the tab, hit Make a Copy, select the Model tab, hit Create Copy here, hit OK, and then you'll have a second tab that works just the same as the first. Very simple. You can do that as much as you want. I really tried hard and I made it a point that all of the logic and inputs and everything is contained on a single tab. That makes it really easy to port around. Okay, so let's say you're a SaaS company and you make a sale here. Let's say you sign on a $250,000 customer. You collect all the money up front. So let's say you collect 100% of the cash flow up front, but you recognize the money over 12 months. This is one of the most common scenarios. So we go, here's the recognition over 12 months. And no, these could be anything. You could collect the cash 50% up front, 50% in 6 months, or whatever. The model would handle it perfectly. Um, but let's look at this specific scenario first. So we've got our $250,000 sale. Here you can see we're recognizing a revenue over 12 months. So 250,000 divided by 12, about 8% of the cash that we collect is actually being recognized. Here's our net income, because remember on the income statement, usually, if you're a larger business, you're going to be on accrual and you got to match your revenue with when you actually recognize it. Um, so we're recognizing that over time. Here's our cash balance because we do have that cash now and it's available, so that's an asset, the whole 250,000. Now if it were 50% up front and 50% in 6 months, you can see now the cash updates accordingly. Revenue recognition does not change. Let me undo this. All right, we have no accounts receivable because we're collecting all the cash here. Now, if we had, we're recognizing the revenue here, but we're not collecting the cash till the end, then you would have an accounts receivable. As you recognize that revenue, your accounts receivable goes up, but you're not getting any cash till the end, so that's still zero. And then here you finally get all the cash, in this case, month 12. Let me undo this back to our original situation. So as we go down, no accounts receivable in this scenario, no inventory, no prepaid expenses, no payables. Now the only liability we do have is unearned revenue. And that's because we've collected cash for services that we've yet to perform. So once those services are performed, we start recognizing that revenue. And prior to them being performed, we have a liability, which is the services that need to be rendered in the future. So as that gets worked off, it finally gets down to zero once we fully, after the 12 months. Retained earnings is just taking the income, net income, and accumulating that. So we end up at 250,000 because we're just doing revenue, no expenses. Assets equal liabilities plus owner's equity. Here's our check. We also have the cash flow statement, so we're zeroing out the net income. We're zeroing out the recognized revenue, which is only thing that makes up the net income, so the zero, and we're just getting the actual cash flows when they happen. Here we're collecting 250,000 in month one, so that all comes into here, right here, and then here's our change in cash flow. Annual summary, same exact thing, but on an annual basis. All this happens in year one. You see the net effect and how we end year one, and you've got some charts here. Now, what's cool about this is if you're going to do this manually, it's quite difficult, but let's say you made a second sale for 250,000 in the next month. Well, now you have to put everything on top of each other and get all these timings correct. And so this model does all that for you correctly. It's tracking your unearned revenue, your cash balance, net income, cash flow, unearned revenue. And again, if you kept making sales, these percentages here for when cash is collected and revenue is recognized, this is a pattern that's applying to every single month dynamically. And that's how the model works, and that's why it's valuable. Here, if we had 2.5 million in sales, eventually our net income or retained earnings gets to 2.5. We eventually earn all that off. Now, if you collected 50% of the cash up front, 50% in 6 months, that's an even harder thing to automate. But you can see it does it here. And our cash flow is adjusting accordingly. And we eventually collect it all. 2.5 million here. And that's the beauty of this. You can handle arbitrarily different patterns for when you collect cash relative to when you make a sale and when that revenue is recognized. Now let's do one more example where we collect the money up front, and let's say we have a accounts receivable, meaning that let's say we made the sale, we recognize all the money up front, but we actually don't collect money from the customers. Let's say we only collect 50% up front and then 50% in 3 months. Well, now you have a little bit of an accounts receivable because you're owed, in this case, you're owed half of the full amount because you've collected half here, but you've performed 100% of the services. And then in month 2, you still haven't, nothing's happened. And then month 3, you finally collect the rest of the cash, so your receivable goes down. Cash is going up. You see right there. Here's the net cash flow effect is the full 250. And then again, this would apply dynamically as you plug sales into here, and it populates your financial statements automatically. All right, so that's revenue on account. That's most of the situations you'll see, or kind of the types of situations. Next is prepaid expenses. So this is pretty simple. It works the same except for the opposite because it's an expense. Let's say you had $10,000 in expenses. You collected or you paid that out right away. And let's say for some reason you actually didn't recognize the expense for some months in the future. Okay, so when we recognize the expense, it hits here. Or let's say it's prepaid rent. So we'll do like 6 months. We recognize it 1/6 of it every month. 2, 3, 4, 5, 6. Okay, so you paid it up front. You've got a prepaid expense here. That's an asset as you use it as you use the rent, use the money for rent that you prepaid. That goes down as an asset because you're using it. You recognize the expense evenly at roughly 17% of the 10,000 every month until you reach the 6-month mark. So retained earnings here in this case is just an expense. As you recognize the expense, this goes negative. Net income is offset with the recognized expense, and then your cash flow here is 10,000 right up front. So very similar to how this revenue worked, except for we're doing prepaid expenses instead of accounts receivable, and It's an expense, obviously, not a cash in item, but a cash out item. So you can plug data in for that, depending on how your model needs to run prepaid expenses, if you have any. And then the more common scenario here is inventory. Now this gets pretty, let's just put it in. So let's say you order $500,000 of inventory, all right? Well, as soon as you order inventory, you are recording that here. It doesn't matter when you pay for it or when you recognize it as cost of goods sold, but the amount you order, the inventory is going up by that amount. Now, let's say you don't have to pay for that for a few months. Let's say you got a 3-month term. Okay, so now you have an accounts payable that hits. So 500, 500, then month 3 you finally pay for it. Well, let's say it's 50% up front, 50% in month 3. Okay, so now your payable is only 250. And now let's also put in for the recognized cost of goods sold that you sell. These could be materials, it could be units of things, whatever the case. Let's say it takes you, after you purchase it, 1, 2, 3, 4 months to sell, and you sell 25% in that time frame. Okay, so you can see we're recognizing that cost of goods sold here. When that cost of goods sold starts to get recognized, we reduce the inventory balance. It eventually goes to 0. Now we've while this is happening, we've decreased cash to pay for that. We've increased the value of the inventory, so those offset. Cash down, inventory up. We have accounts payable as a liability going up, and then it goes to 0 once we pay that cash out. And we have retained earnings. Once we recognize those expenses, is going, well, it's negative here. This all balances assets equal liabilities plus owner's equity. Here's your cash flow reconciliation. So really, this is the only thing that happened with cash flow 250 out in month 1 and 3, and that's it. Now you could have a bunch of different scenarios here. Let's say you purchase these things, you sold them all, recognize the expense in the same month, but you didn't have to pay for it until a month in the future, or let's say a couple months. Well, now you have a payable of the full amount. That's pretty much it. Month 1 is when everything actually happens. So the cash goes out. We recognize the expense. It's hitting retained earnings. And then the only thing that's really changing is your payable is going down to 0 in month 4, and the cash is going down. So you have assets, both of these, well, you have asset going down, and assets equal liabilities plus owner's equity. So you also have your liability going down, so we balance. And that's how that works. Now, if your inventory here was directly related to when the revenue recognition was happening, let's say you purchased this inventory for 500,000, you sold it in the same month for $1 million, and from your customers you collected, let's say 50% up front, 50% in 1 month, and you recognize that revenue right when you purchased it or sold it, so month 1. Now we can see, well, we sold it for $1 million, we paid 500, so 500,000 profit is what our retained earnings should be, which is the case here. That actually all happened in month 1. So we have revenue, expenses, net income. You've got accounts receivable because you still are owed half of this after month 1, since we're collecting 50% up front from the customer, 50% after. We've got our payables because we aren't paying for that inventory for 4 months. So even though we purchased it and sold it, we don't owe till month 4. So we've got a payable here, and our retained earnings starts at 500,000 profit, and that's all it is. And here's our cash flow reconciliation. Now this is saying, well, we collect $1 million and then we have to pay for it back here. So net, we have 500,000 in cash, which you can see here is our cash position over time. Now, this pattern that you defined in D&E and L&M will apply. So if you keep doing this every month, now let's just do it for 2 years. Okay, now this pattern keeps happening. You can see the effective cash flow over time, retained earnings. Here we end up making $12 million profit, which is just the 24 less than 12. But accounting has a really complex way to come to the correct number, but it is a nice, elegant system that is very detailed. Here you can see the cash flow reconciliation on the cash flow statement. We've got our annual summary here. And, you know, if we just wanted to do this for all 120 months, you could drag this all the way down. Here's your data over 10 years. Where you get to your cash balance, we're getting up to 61 million. Now, note the 61 million is greater than the 120 minus 60, but that's because we have some favorable terms here. So in the very last few months, we actually don't have to end up paying the 500,000 here that we owe for anything that was bought in these last 3 months. So there's a little bit of a offset happening there, but the model's handling what should be happening in the given year correctly based on the timing. Here's your charts. And then all the logic for how this is happening is all, if you want to see it real quick, all of this logic down here, about 1,600 rows is how all of this is working. And on the top left here, you can minimize it by hitting the 1. And you can see here is the revenue logic, expense, prepaid expenses, and inventory logic sections, if you want to minimize it. You could also minimize these at the top if you want to hide and only show like one section. If you're only using one and you want to see more of the statements over here, or you could hide them all, or what have you. So this is very, so I've done a financial statement generator for actuals, which was, you know, involved a lot more types of accounts, but I've never done a specific receivable and payable, or essentially revenue on account, expense on account, inventory on account logic without doing it in another model. So now you can take this logic into any model that you have and use it and produce these outputs and then reference these outputs in your model instead of having to figure out how to build all this logic, which is very difficult. And then you just have an easy input here. You have patterns for when you collect cash and recognize revenue, and the model works accordingly. I think this is probably one of the most useful accounting tools I've ever done, and it's good for learning as well. Like if you're an accounting student or if you're just getting into 3-statement modeling, financial modeling for a profession, this is a very good place to learn the intricacies between the financial statements, the logic between them, and what should happen based on what you're putting in these logs here of sales and expenses. But it's also great for you know, seasoned pro financial consultants that are trying to do financial modeling for their clients and just don't know how to do this logic correctly. And if you don't, you won't get the right cash flows, especially, again, this is mainly for people who are having revenue on account and or inventory on account purchases, and recognizing that revenue or expenses over time and not all up front. So this is the harder part of financial modeling that comes up, and it's a great tool. I'm selling this tool, only $45 one-time fee, and you can download it forever. It'll be available at smarthelping.com in the accounting section. If you want to check that out, we are right smarthelping.com in the accountant part, and I will list that under the calculators. It'll also be included in the bundle for $249. And it will be included in the Super Smart Bundle for $9.99, which includes all the templates on the site. I've done, well, it's got to be over 200 now. startup financial models for a bunch of different businesses. Usually I do models that have, revenue, expenses, full everything that the business needs to project. But sometimes I do tools like I did today where you've got, a specific accounting function that you want to be able to show happening, and it's really accounting heavy, but we're focused on just the logic of selling things on account and buying things on account. If you scroll down here in general, you'll see that financial statement generator. You might be interested in this. It does, here it handles a lot more things, but it's for actuals. It's not for forecasting. It's just to put in actuals and produce actual financial statements like this. And it does accrual, it does cash basis, but what we've done here today is more of it's for accrual systems, accounts receivable, accounts payable, and just that, and it's mainly for forecasting. So you're defining a single type of pattern, and then that pattern is applying to all your numbers as you put them in. The reason why I did the percentages also for up to 120 months is because you might have longer cycles, sales cycles, payable cycles. It might take 6 months to collect half the inventory, and another 6 months to collect the other half, or collect the customer receipts or what have you. Um, but super valuable here. Also, guys, I do custom work, custom financial modeling for a living. So if you want to hire me, you can. Right now, onboarding new clients at $275 an hour, and I work on all things finance and accounting. Mainly financial modeling though, in spreadsheet work. So let me know if you want something done. I also have quite a bit of skills in Google Sheets and some scripting ability. So depending on what you kind of want to do or build, uh, I'm likely able to build it, but just let me know. You can email me, Jason at smarthelping.com. I've also got a thing here that shows you how much the average job takes in hours, how much it costs, and some bell curves for total hours of a job that I've done on smarthelping.com for the last, well, what is this, for 7 years I've got data for. So you can see generally, jobs are going to take somewhere between 3 and 5 hours usually, but they can go longer, 9, 10 hours. On getting more into the edge case, I've got a couple longer term clients here. Those are those dots. But usually this is where the average job falls into, under 7 hours and under $2,000. And I usually get stuff done in that time. Alrighty, well, that's all I got for you. And I will see you guys on the next one. Like and subscribe.